Joining us with our Ag Week Extra Market segment this week is Jim Emter with Van On & Company, and let's talk just a little bit about the two things dominating the grain market right now, weather and trade. In trade, the market is kind of in a little bit of a show me mentality right now, isn't it?
It is. It really is. You know, we get to the point that we've got a lot of these rumors and talk, and now it's a matter of who's going to take action and who isn't. You know, the U.S. is approaching the market as if, hey, we want to kind of close the gap here to some degree, and others want to keep as much as they can, whether it's China, whether it's Mexico, whether it's the EU and Canada. So this new component this week was really kind of those NAFTA/EU organizations coming after those steel and aluminum and saying, hey, if you're going to come after this, we're going to look at some things ourselves. And that creates an edge of uncertainty. So what will actually come? The market, as you said, really wants to see what action will take place. Will you actually put an implementation on Mexico in the pork arena? Will you actually go do something here directly to a corn market? Now, what we've got to realize at the end of the day is these are nations that ultimately need these products.
Right.
Canada, Mexico, China, they don't have a lot of other options to go get corn or soybeans. Yes, Brazil has got a major crop right now, but we've really got to tie into the fact that even if they bought all of Brazil's beans, let's talk China for a minute, you buy all of Brazil's beans, you still need the U.S.
That's right, they do. And we look at trade from not only the Mexican perspective in Canada and the EU, as you mentioned, but China. And we're going right now in a trade situation where it looks like longer term, there may be some gain once we get through this pain, do you think?
Yes, I really do. I think that's the next step, because when you look to the fact of what does China want, what does Mexico need, it is grain products. When you close these gaps, I ultimately think the very thing that we're leveraging right now to try to get better trade activity from the U.S. will ultimately benefit us 5 years from now, 8 years from now, 10 years from now. So it's short-term, long-term of trying to find that balance and realize, hey, it may take some retaliation in the near term, but it's also understanding the fact that as of right now for 17-18, we only can sell about 1,000 metric tons per week and only 41,000 metric tons per week in soybeans. So 91 in corn, 31 or 41 in the soybeans, and we sold 828,000 metric tons here this week, and we've also got a decent enough bean sale where we're meeting and exceeding those expectations, and we've got to meet those until September. Then we're going to start to look at new crop. What we've really seen slow, and we saw this last year, was the new crop export business was a little slow coming, but last year we had a record Argentine crop and a record Brazil crop. This year we've got a fault in Argentina with a crop loss, to a large degree. We got a big crop in Brazil, but those dynamics change a little bit where I think the demand is going to be very strong August and beyond.
The uncertainty about trade is caused the funds to liquidate a lot of their long positions in corn and soybeans in addition to the favorable weather. So with that in mind, as we go into this report coming up, do you think, unless we get anything that is a big surprise, that market can maybe start to build a base here now and the funds will maybe add back some of those longer positions?
Well, I think the biggest thing always is to find that stability point first. And I think the charts give us that in corn around this 378 mark. I really look for that July corn contract to be supported there. What can happen, though, is as we work past June, we may see the September and December board, just because of the carries that are out there, they may lose 10 cents. And ultimately, we see the September get down to that 380, the D's maybe trade down to a 390 type price count. But we see pretty good base of support, at least for the next 3 months, around those areas. Whether we can build or not is dictated off of weather. And what we need to realize is we can get all the rain right now, have a great looking crop, but if we dry up during pollination in corn or for soybeans, which are made in August and September, we get drier through that period, a lot of dynamics can change very quickly. So we want to be careful assuming that we've got weather completely figured out, because just when we do, it can throw a real wrench in the marketing plan.
Well, and weather's really the one component that would be able to get us through the previous highs that we've had here a couple of weeks ago when we had those reversal days, right?
Correct. Weather, and then also these trade tariffs and implication. If you can all of a sudden get a warmer and drier forecast, and you couple that with the fact that some deals are worked out, or we get a real E85 strong mandate to corn usage, there's a number of variables that'll come in here. What we also need to keep in mind is when you look to August and September, we're going to be very tight on meal around the world. So keep an eye out of that meal market out of the corner of your eye. That may be the market that surprises us on its ability just to say, hey, we can only go to the U.S. to get meal supply, and whether it's bought by Argentina and shipped to China due to the trade tariffs, or whether
Which
China
they're already doing.
Exactly right. Or if they come right to the U.S., I think we are going to see very strong meal demand as we work into fall.
The wheat market has a weather story as well. That one is different because it's global, and we've also seen now some of these yields start to look not as good in Kansas. So will that market be able to keep going to the plus side? Will we be able to take out some recent highs that we've put in?
Great question. I think it really depends on how big of issue we've got in the EU, Russia, Black Sea region. When you look to wheat, we refer to it as a market that has 9 lives, and our ability to really get up and get going is to have a legitimate problem. When we can revert back to the '07 market, that was a market where we had multiple big producing nations that had problems. I think many people in the United States get frustrated in wheat that we've got a problem in winter wheat country, but we're not able to run. We need to remember we are only the 6th largest producer, and we produce about 46 million metric tons of wheat. We've got Europe, we've got China, we've got Russia that are producing into the 100 million metric tons of wheat. So we are a very small component of the world picture, and our export demand has been very limited. You get problems over there, that's when things get interesting for the U.S. when we all of a sudden become a rightly priced nation.
Now, spring wheat was the price leader last year. This year, because we do have these favorable conditions now after we finally got the crop planted, are we going to maybe make some adjustments with the spreads? Is that how the market's going to start to deal with all of that?
Well, yeah, I think the biggest component for spring wheat was the fact that protein was a story last year. The world did not have a lot of protein. What happened this year is as this wheat crop shrunk in the U.S., it brought up the protein level. A lot of times when you put stress on winter wheat, those protein levels will pick up a little bit. It's been a little bit hit or miss so far, but I think that was the market's uncertainty, and that took a bit of edge off the spring wheat market and what's allowed us to kind of hover in this $6 to $6.50 market. You had a market that if we had an okay crop in winter wheat country and we didn't plant a lot of spring wheat acres, this spring wheat market just protein-wise could have had a much bigger story this year if that drought in North Dakota continued. But as you watch systems come across, we've basically, over the last 8 days, have coverage over about 70% of North Dakota. There's still some dry pockets in the northeast region and the extreme, kind of southwest of Bismarck area. There's some areas that are a little too dry down there. But when you look at wheat, we've seen some improved conditions. We see the U.S. production that is down to some degree, but at 900 million bushels, that's still not a story to get overly excited about.
Next week, we have the report coming out on Tuesday from USDA, and we're working on new crop balance sheets now. And as we look at those, corn is well under 2 billion bushels, which is favorable. Do you anticipate we're going to see many changes, though, in the balance sheet there, and will USDA pretty much leave yield as is?
Yeah, the June report, typically USDA's got their own measures, and we don't know, we wish we knew what they were, but they've got their own set of circumstances. What they oftentimes will take a look at is just what was the planting pace, how quickly did the crop get in, what are emergence level, and then they'll look at those good to excellent ratings. If there is a risk, Michelle, and you alluded to it earlier as we were talking, you could potentially have something where they uptick yield a little bit based off the strong crop conditions.
Sure.
We don't anticipate that really until the July report. July, August, SEP is when you really start seeing USDA start to adjust these back and forth, but they may try to show, hey, the crop conditions are legit, a small yield increase, but we don't expect anything too great in that manner. What I really think the next big report is June 29th. When we look to corn usage, I think that is the big dynamic that if we're going to set up a little bit more of a bull story, I look at our feed use numbers that we've got 109% on feed, we got higher numbers in the placements, but yet we're using less corn. I think that's a suspect number to us in the feed use arena. And I also look to the export pace that we can only sell 91,000 metric tons per week and from now to September, and we're averaging about 800,000 metric tons. So in my opinion, the export arena might show some shrink in that stocks number.
Sure.
We may see it out of the feed use. And I think from really around this June 29th to about July 20th, that could be the last hurrah for the corn market. And if weather conditions are good, it may be all over after that.
We were already kind of suspect about the feed usage number in the last quarterly stocks report, so a good point that you bring up. What about soybeans? There's already talk that next week's report that USDA might increase yield because we started off with 75% of the crop in good to excellent shape here already.
Yeah, similar circumstance to corn. You're going to look at a circumstance where either in June and July, as long as weather conditions remain favorable, USDA is going to make a move. Trying to outguess whether it's going to be June or July, it's difficult to do. But I think the market's starting to price some of that action in, and I think that's what we need to get our hands around is with soybeans hovering now just at $10.10 and approaching $10, and the corn market, new crop hovering around $4, we're starting to take some of that weather premium out of there. So I'd say it's kind of a sell the rumor, buy the fact type atmosphere, but weather's going to dictate whether or not people are buying the fact of
Will USDA make any adjustments in the next report here because of what we're hearing about the lower production in Russia? They're already downgrading both the forecast for production and exports, but will USDA even deal with it in this report?
I don't think they will in this report. When you look to a lot of the circumstances, USDA is very slow coming. Look at Argentina, for example. They were about 3 to 5 million metric tons behind in Argentina's reductions and about the same in the Brazil's increases. So I think they're a little slower to react just because they don't have a handle on it. These are nations a lot of times that we don't have the inside scoop. They've got all the infrared satellite imagery that they can try to make their decisions off of, but they're usually a little slower. So those will come, whether it's June or July. I don't want to get into the guessing because that's really what it is at the end of the day.
Let's move over to cattle. It looks like the chart action, we put a bottom in perhaps there, so on the futures side that might be confirmed. We don't know on the cash yet whether the bottom is in. But what do you see going forward, especially since maybe we've now moved past this wall of cattle or we're getting through it, and then we come into a little bit less of a demand time period after July 4th.
Yeah, and that's the thing. If we can have a strong July, August with demand and kind of extend that season, remember, it was cool to start this year. And that was one of the kind of parameters that allowed that August contract to go back down and test $98. Well, we've accelerated, we've put in a double bottom, and now the question is, what do we need to get to? Right now, we're viewing the 200-day moving average, which would be right around 109 off that August, as really a key area that we can at least get to in the near term. Near term, how big? A month, month and a half. But what we need is we need to see continued strong exports. Last week was very encouraging in regards to exports, carrying through on that and then coming in here and building off that momentum in the cash. So you hit the nail on the head there with a 111 to 115 trading range so far this week on very light volume. Strong Packers margins. We know Packers can stand up as those numbers get tighter. How quickly does that happen? I really think it's over the next month and a half. It's just trying to outguess this week versus next week can be difficult. But we see a more positive tone towards cattle. We see us getting up here $3 to $5 more, and then we'll see how we handle that 200-day.
The other interesting part about the cash market, we had been working so much in May on all of this forward delivered, all of these delivery dates that the packer had bought for all these weeks in June. We're not seeing that as much. What does that tell us about the dynamic of the cash market and what the packer mentality is?
We're getting current. What that tells me is the availability is getting a bit tighter. It doesn't mean we're pushing for cattle too hard yet, but the reason packers were out there is they had things locked up, so they want to get out there 2-3 weeks, and you had to really pay attention to, well, what's selling this week? If we're getting this price, is it off of current or is it off of deferred? And right now, I see a market getting more current right now. That's encouraging to kind of the bird in hand, two in the bush, that all of a sudden they're going to want to push for spot cattle. And that ultimately, in my opinion, is what's going to get us a firmer cattle board and eventually get us up towards that 200-day moving average.
The hog market dealt pretty well with the announcement of the Mexican tariffs. In fact, the day after we had a big up day, so very bullish convergence or divergence from what we would expect the market to do. Is that an indication that this market is able to start pushing through these resistance areas on the charts? Are the funds who are short now going to help push us through that with technical buying, or what's going to happen?
Well, I think that's the combo, is we need to watch this managed money product for both cattle and hogs. It's been stiff liquidation. You look at where we're at right now, and we're talking 10-year type lows that we've seen off of what they're holding right now, and hogs are actually short. So we haven't seen that too much over the last 10 years. Let's talk specifically about what we're looking at. We're looking at a hog market that has come together to some degree in weights. Weights have been a problem in hogs for the last year and a half. We've got a market that is becoming a bit more current in what is typically a seasonal slide in weights. What'll happen, though, is we'll hit a reversal here in about a month and a half, 2 months. So near term, can we get up to 82, 83 off these summer months? Potentially. But I still think those resistance areas are going to hold here for hogs. Doesn't mean we need to fall apart, but at least I think good marketing approaches in those areas are important. From there, I look for these weights to come back up, and as soon as this board falters off because of the inverse we're in, always keep in mind the summer months are strongest for hogs, and then we'll see a fall off as we get further out towards December. That fall off can tend to push those weights back up again, and that's our limiting factor. So when we talk about the tariffs and the implementation, we need to see a circumstance where Mexico actually has a retaliation that is set, and we start to see it impact our numbers. To just come after here on legs and shoulders or this or that, they're being a little tit for tat. at as to what they're going to do, when we actually see the implementation of less hogs being exported, then the market will react.
All right, but Mexico is still our number one customer by a value standpoint, or actually not value, but volume. Japan's still number one on value, right?
Yep, correct. You've got that base around there, but we just need to realize that where else is Mexico going to get them? Are we going to start seeing imports in? And that's where this trade war gets difficult, because there's so many countries that are dependent on the U.S. because, again, a lot of times they want to ship off U.S. dollars. You've got a strong U.S. dollar. The currency valuation isn't great, and that's what's created some Brazilian selling in beans. But just a lot of details where countries want to come to the U.S., and there's a lot of components out there that I think make a brighter future for ag, but right now we seem to be the negotiating factor of the ag sector.
Yeah, let's hope we get this all negotiated through. Appreciate your time, Jim. Thanks for being with us. Jim Emter joining us with Van On and Company here for this week's Ag Week Market Extra.